I think that separating luck from skill is very difficult. So of course, what they say. I think probably always Napoleon is it. Find me a lucky general rather than a skilled one. I think you hear that in geology very often. Don't you? I don't want the best geologist, I want the luckiest one. There are some academic books on actually trying to separate luck from skill statistically. I think the one that it's fairly reasonably heavy reading mathematically, but I think it's called something like the success equation, and it'd be from an American publisher, fairly scholarly book, and it actually tries to separate out and statistically do the work on different sports. And unfortunately, with it being an American book, it had more American sports than so baseball was there. Baseball was quite heavy luck. Luckily, chess was in there. Chess was almost 99% skill, 1% luck type thing, as baseball might be, I forget the exact percentages. American football will be in there, basketball and so forth. And so when we do our analysis of directors, there's a halo effect, clearly. So if you're lucky enough to go and, I recall when I worked for WMC, Cambaldo, we had a new graduate come in, his first diamond hole that he drilled, he hit a new nickel chute. We thought, wow, fantastic, that's great. And that really, really helped his career post WMC. You could sort of say, hey, I discovered this deposit, right? And if one assumes that the first hole that he would target wouldn't be the most skillful job he'd sort of ever done, that there was a little bit of an element of luck in that you're in the right environment. So statistically separating luck from skill, one can do, but clearly the market for luck and skill is not efficient.
If you don't know Allan Trench, then I think you're missing out on an opportunity to listen and learn some really interesting things about our industry. Allan has a PhD in geophysics, an MSc in mineral economics and an MBA from Oxford University. He's professor at the UWA Business School, where he runs the MBA program. He's published about 10 what he calls 10 worst-selling books that cover industry trends, strategy and other snippets of wisdom, and has written hundreds of op-eds for mining news journals. He's also director of 2 junior companies on the ASX, and he has been on the board of 18 others over his career. So naturally, I start by asking him whether we need an MBA to run a mining or an exploration company, which gets us into all sorts of trouble by veering sideways into game theory, Chat GPT, rare earths, Bitcoin versus gold, green gold and tokenization of gold, and various other interesting subjects. We dive into gold a bit further by discussing the value of an ounce of gold in the ground in different parts of the world, and whether gold will be here in another 50 years from now, and whether we should invest in gold royalty companies, gold ETFs, or gold producers. Back to governance, Allan shares some thoughts on small company boards versus large company boards. We talk about quality of governance in the mining industry and board compositions. We close off with Allan's shiny new toy strategy, and of course, I couldn't help but ask him about his crystal ball predictions for the industry in 2023, in which lithium also makes an appearance. Lots of cool books and resources that he shared as well along the way, which I put as links in the descriptions. Let's dive in. Hey, Allan, nice to see you.
Great to see you, René. Good to see you.
Thanks for coming on the show. It's early in the year, and we've been talking late last year to try and find some time, but you're a very, very busy man doing lots of really interesting things. So I was really keen to chat to you, but really appreciate you making the time. So yeah, thanks for coming on the show.
No, great stuff, René. Look, it's a pleasure to be here, and nice to be able to talk a bit of shop, I guess.
Yeah, for sure. I've got a whole bunch of questions, but we'll see where we actually land. I never know at the start anyway, but maybe first bit of history land, because I did delve back into some emails, and I think where we first connected was through Jeff Collis, who used to work for Anova, and he hired us to do some work, and then we did some work with Jeff, and you were involved with that. And then I think in 2015, I figured out what you did, and I talked to you about doing a presentation in New Zealand, and I thought you came all the way to New Zealand to present to us at the conference, which was really nice. And obviously, stayed in touch before the viewers. And probably you're the best one to give yourself an introduction, but obviously you're you've got a directorship or have been on the board of more companies than probably are listed on the ASX. So it's a space where you got some experience. But if you can maybe give us a brief introduction to your career and to the point where you're now, and because you're sitting at UWA where you're obviously teaching as a professor. So how does one get to that point in their career?
Oh, wow. Well, I would normally like to start with the end to give the conclusion, but I will follow your lead and sort of maybe start at the beginning, but I'll keep it brief.
Sure.
My PhD was in geophysics. That was in the late 80s, and it was in magnetics, which I loved. Why did I do a PhD? It was the usual reason that the oil price was down at the time in the UK. There were no jobs in the North Sea, so you do a PhD. Probably the best thing I ever did. I then did various postdocs, initially at Oxford, and then came over to UWA way back then in the early 90s. Realised that my students in geophysics were getting paid more than I was when they went out into industry. So I sort of gave up on academia and went to Western Mining for 5 years, WMC, and initially as a geophysicist, and then thankfully they gave me the chance to be an exploration manager there.
Yeah.
And they were also very generous, WMC, in the fact that they allowed a study leave program where you could take a week off here and there. I did a master's in mineral economics. That whetted the appetite, went back to Oxford and did an MBA over there in the late 90s. And again, that opened up lots of doors. So I joined the McKinsey and Company in Sydney. Had an office. They had an office in Auckland as well at the time, and they still do, but I didn't get over to New Zealand. So then really got into that sort of management consulting space in the early 2000s. And that really opened the door to lots of boardroom opportunities. And so, as you say, I actually have lost count of how many companies I've been on the boards of over the years. I think it's around about the 20 or so mark.
Yeah, wow.
Unfortunately, I can't really point to any of those having become $10 billion companies.
They will come.
We normally end up with 200 million is sort of not bad. It's that sort of thing. Maybe one minor sort of reflected glory. I was the chairman of VentureX Minerals, which became Bill Beeman's develop with the Sulphur Springs copper VMS deposit up in the Pilbara. So I was part and parcel of acquiring that way back when. But so many board roles, a lot of consulting, which is part of what brought me to New Zealand back in 2015-16 with a group called CRU Group, that used to stand for Commodity Research Unit. Yeah. Fantastic entity to work with, and I still do part-time work with them. And then back in about a good timing choice in about 2011, Cam McQuaig, who's now at BHP, was at UWA running the Centre for Exploration Targeting at the time, and asked, look, we've got this position in sort of mineral economics space, would you like to come back? And I said, happy to do that on a fractional basis. And that's meant now an 11-year association with UWA, which has moved me from geology now into the business school. So I run the MBA program here, which is a great privilege. So a few hats there, René, and luckily I get to meet great people like yourself along the way through, as you say, the Jeff Collis I still keep in touch with as well. So mining and exploration is a small world. So
it is, and that's what excites me. I mean, just seeing all the people that are now in Saudi, for instance, at that conference. I just have a severe FOMO at the moment because it would be so much fun to hang out there and share all these experiences. So, it's a pretty close-knit industry as well. So, always interesting to see the connections. But yeah, what an interesting career. And look, there's so many points to hook into that. But so maybe before I do that, so how much of your time do you spend on an average week? And I'm guessing you're not a 38-hour per week man, because otherwise you wouldn't be sitting there. But how many hours a week do you spend on the sort of academic side and on the corporate side?
I'll give you the formal answer because I actually don't know the real answer.
Sure.
The formal answer is I'm 75% full-time equivalent, as they call it at the university.
Yeah.
But inevitably, just as in exploration, academia, everything's as long as a piece of string. So you just sort of keep going. And luckily, there are some nice synergies. So when you're sort of teaching onto an MBA program, if you're doing some consulting, say for a mid-tier mining company, it's a good opportunity to ask, say, the CEO or the technical director, would you be willing to come and do a presentation to the MBA students? So there's some nice overlaps there. But I'm certainly not working as many hours as I used to do when I worked at McKinsey, put it that way, René.
Yeah, fair enough.
It's probably only a 2-figure number rather than a 3-figure number.
Oh, wow, geez, I don't know if I'd ever get to that, but it's interesting because I was just having a few conversations on this channel as well with some of the younger entrepreneurial people, starting juniors, and particularly in Canada, but I'll be talking to some on this side as well. And one of the questions that I ask, how do you roll into that, right? Because it's a very entrepreneurial space, and you don't see a lot of people with an MBA necessarily picking those roles up. Like, there's some land and there's some people, and there's an idea, and let's go and do something, and people throw some money at us, and they're very successful and have done very well. So the obvious question is, do we need an MBA?
Oh, that's really interesting, actually. I'll try and answer the question directly first before I sort of wander off topic. I think, look, an MBA helps people. It helps some people incrementally, and other people it helps them in step change. So it sort of never does any harm. But you can certainly succeed without an MBA. Actually, I joke and say over my time, somehow I've written 10 worst selling books, right? So my publisher, who is Major Street Press, recently published a book actually by a New Zealand author, and I apologize, I forget the name of the lady, but her book was called, You Don't Need an MBA. So clearly there are some fantastic people that run startup businesses and even run big businesses that haven't had an MBA. They just do it naturally, and they picked it up on the job. So you don't need one, but it never does any harm, I think is the short answer.
Yeah. Well, and I looked at this a few years ago as I was trying to get more serious about my business and some of the other things I was starting. I think, there is something missing. And I'm always wondering, and again, maybe I'm veering off topic if there is any to begin with, but, are the people that buy the self-help books in the library, are those the ones who are successful, or, or are they the ones trying to find what they need to do from a book and will just never get there? And a lot of it is obviously fairly intuitive. But there must be writing a good business plan and setting a good budget and having some financial checks and balances in place, and a number of other things about risk management. And I'm sure you don't just pick up on the shop floor. That would be interesting to.
Yeah, I think, and it's around about this time of year, the Christmas, when you're stuck for an article, because I sort of write articles each week for miningnews.net, and. I think we've managed to avoid doing it this year, but when you're normally stuck with an article about this time of year, you reel off some sort of reading list for the sort of summer holidays and the like. But there are some sort of absolute classics that I've come across during the MBA that really have changed my sort of whole mindset on business. And I recently joined an advisory board of a small sort of METS provider, not too small, about 20 million revenues per annum type player.
Is it the Wireline Service Group?
It is, that's right. Yeah. Yes. Yeah. And the first thing I did was, I know Matt Main for 20-something years, and I said, Matt, have a read of this book over Christmas. It's a little book on game theory, but really what it is, it's around being really smart around contractual things like preferred customer status and all sorts of things to put into contracts that help the customer and also help you as the provider. So those are things that I think you can sort of pick up some tips.
Look, for sure. People write books because they got something to share, right? So there's, and I try to put those things on my list when I either talk to people here or otherwise meet, people who have these recommendations. What's the name? I'm happy to put a link in here because that's one.
That's right. The authors certainly don't need the money. They've founded various businesses themselves and made a lot of money. So the book's called Co-opetition. It first came out in 1996, as I recall.
Yeah.
It's by Adam Brandenburger and Barry Nailbuff, who are both one's Harvard, one's Yale. I always forget which is which academically. But it actually just had its 25-year anniversary, obviously, say 2021. And The Economist wrote a particular piece on it, 25 years on from the publication of this.
Oh, right. Yeah.
Actually made game theory understandable to those of us that struggled with the mathematics in their geophysics, put it that way.
And the geology degrees, I guess.
Qualitative perspective on game theory, but some beautiful examples, everything from corporate M&A down to, as I say, small contractual type arrangements. And absolutely loved it. It's one of the sort of all-time classics of the MBA reading list for me.
Okay, well, look, that's going on my list then, and I'll put a link in the description because I'm pretty sure people are interested in that. And there's always things to learn, and the business side of things. I mean, I didn't do any MBA. I'm still jealous of people. There's this sort of feeling of like, you've learned something that I also want to know. I just don't have time to do it. But remotely, I've been thinking about doing it remotely. But then, what quality of education do you really get? And geez, I don't even have time to go for a run in the morning. So let alone pour my heart and soul in an MBA.
Well, actually, I should a big shout out to my wife of 33 years or something or other. So, 1998, 99, I took a year off to do an MBA, and it was a lucky time because the market was pretty poor. But I was intending to do one part time, René, and then I for whatever reason realised I could go back to the UK and spend a year in Oxford, and I thought, oh, that's good. I can't turn that down.
No.
And my wife was very, with some young children, 2 young kids at the time, and we said, hey, let's do it. And so that was a good decision in hindsight. I think doing it part-time, I've done other master's degrees part-time, and at different points in time, both have worked, right? So master's degree part-time worked for me in mineral economics, really loved it, and taking a full year off to do an MBA worked as well. So just... And
it all depends where you are in life and what's going on around you at that point, obviously. So that's different for everybody. But you talked about books. I mean, and your 10 worst selling publications. But you put something out in 2016. around governance in the minerals industry, or perhaps I'm not. I mean, that is not the title. But to turn into a question, if you correct me on the title of the actual publication, what are you noticing in the current ASX landscape, if we keep it close to home, particularly in the mining space, because you could talk about, I guess, talent drying up, and with all these directors without too much experience coming in and seating all these juniors. Are we making discovery? Are we finding more? Are we doing it with more respect for shareholders' money, or is the place less safe than it used to be, or do you see us being in a good place? And various other questions that probably lead from there. But any thoughts?
No, thanks, René. Although one of the last worst selling books, I think that may have been the last one, it was called Strictly Mining Boardroom. This was sort of volume 2 of it. And the thinking behind all those sort of books, and there were a couple of them, really came from back in the old McKinsey days to some degree, but I started writing a column for Mining News in about 2005 or 6, and still do. So we're at column number 870 something or whatever it is. And we tried to take the better ones of those and put them into a couple of books. But the thinking behind it really was there was almost this sort of emperor's new clothes type moment that sort of came about probably back in the McKinsey days, and then certainly when I ended up on some boards myself, of almost like, probably too cliche, but it's either blind leading the blind or emperor's new clothes. So you sort of get the general idea, and it's that the boardroom sort of quite often more commercial finance people are sort of trying to rely on the technical people, but don't understand the technical side of the industry that well necessarily. Obviously, there are exceptions where you might, and then you've got the technical people really almost trying to rely on the finance and commercial people to try and make the right decisions, and neither understand each other's world all that well. And so the books were really to try and sort of create some form of Venn diagram of overlap there between those two spaces, that actually neither group on their own can sort of succeed, and they really need to try to speak each other's language and sort of understand each other.
So how do you get there then? Because I mean, there is always the cliche in the industry is, and you hear it all the time. Oh, that company is a bunch of accountants and lawyers, so I'm not going to invest into that. Because what do they know? I guess on the other side, a company just run by geologists is probably arguably also not the best place to be. So how do you get out of that? Is that the realm of the competent chair that sits on a few boards that has done it before, but there's no blueprint for this, or?
Well, it's interesting. I mean, the short answer is nobody knows, René. I think there's a quiz show where you can put up a sign saying actually nobody knows the answer, right? But there is some work that's been done on this, but it's not definitive, right? So the work that I was lucky enough, actually, it was actually part of my old MBA work. Luckily, I managed twist their arm to let me do some research on board compositions in the mining and exploration industry. What you sort of can demonstrate pretty clearly is that I think way back then, 20 years ago, I looked at sort of 25 gold companies and 100 explorers. Mm-hmm. So you can analyze the gold companies by size of gold company. You can analyze the explorers in terms of whether their market cap was $5 million or $100 million, that sort of thing. And there were some really clear patterns in the data that, to be honest, if I'd made the data up, I couldn't have made it up better. Right? So the explorers at the time of the 100, it was roughly about 51 it was, I think, out of the 100 were led by geologists of the explorers. And for argument's sake, let's say I think it was 20% what we call entrepreneurs. That's sort of really hard to work out what they were, but they're sort of, we all know the people. Maybe about 20% actually, interestingly, by engineers, and then the rest would be your lawyers and accountants. But if you then looked at the gold miners, and we had at the time a lot of the consolidation hadn't happened, so there were 25 gold miners on the ASX, and there was almost perfect substitution of geologists for engineers, right? So the geologists went from 50% of the exploration boards down to about 20% of the mining company boards, and the engineers went from 20% explorer boards up to 50% of the mining company boards at managing director level.
Right.
And then the other interesting trend was, so it's almost like, as a geologist, hey, if you ever find something, you're going to lose your job, right? Because it seems logical when you've got a mining operation, you want an engineer to run it, right?
Yeah.
But the next trend that was fairly obvious and probably predictable was, as the mining company got bigger, the mining engineer loses his job too, or her job, I should say, these days as well, obviously. In the fact that as the gold companies grew bigger, the mining engineers were substituted by the accountants, bankers, lawyers, right? So, and again, if you were making up the data, that's what you'd expect. Who do you want to run an exploration company? A geologist. Who do you want to run a mining company? A mining engineer. Who do you want to really run something that's quite a complex financial company as a gold mining with multiple operations? Probably someone that understands finance really well, or law. So those data were really pretty clear, and that sort of study's been repeated. The patterns haven't changed that much. The one little thing that did change quite amusingly is in the IPO world. You can pick on an IPO analysis. In the early stages of a rising market of IPOs, it's all the geologists that list IPOs. In the later stages, when we've sort of run out of geologists, it's all the accountants and lawyers that are also finding any bit of moose pasture and listing that, right? So there's a clear pattern there as well.
Nice.
But the study that hasn't been really done is to come to the core of your question, which is, which one is better? So do explorers run by geologists outperform explorers run by accountants and lawyers in the boardroom, and how do you do that compositionally?
Yeah, and how do you measure that success? Yeah.
And those studies haven't really been done. I think that's, it's tough enough to get anyone to do a PhD even in geology, but quite a few people do it in geology. It's really tough to get someone to go on and do a PhD in that sort of business mineral economics space. And so there are many careers worth of these sorts of questions that haven't been answered, which one could analyze very clearly empirically. The data's there to do the analysis.
Yeah.
As another example of a conundrum that nobody knows, to put the sign up, but people have very strong opinions on, is this perspective of, you list a company as an explorer for, say, gold, and then say lithium gets hot, do you drill out your ground for lithium or acquire the leases along strike that are prospective for lithium, or do you stick to your knitting, to use the cliche, and stick to gold, right? Mm-hmm. So again, people have very strong opinions on which you should do and which is better for your shareholders, but no one's actually, the data exists. You can analyze back over the history of lots of exploration companies who wins. The jockeys that change horse halfway through the race, or the switch commodities, or the people.
Well, you can see why people do it, right? And I was talking about this just the other day, because the frustrating bit for our industry is, you put some drill results out and they're nothing short but spectacular, and the share price goes down. I mean, what the hell? And you put your maiden resource out and you think that's, it's a major milestone. It's a good resource and it's more than you were expecting. Share price goes down.
Yes.
But what lifts it up? Putting a couple of rock chips out with lithium in it on something that nobody even knows whether it's what the geological situation, but it's lithium, and people will pile in. So if you really think about value for shareholders, then yeah, you should probably do that in the short term, but not for the long term because you're developing this project. So, it's quite and like this is not my background, right? I mean, I run a consulting company and a junior explorer, but not to any great depth of funding yet. I mean, one project and lots of learnings, obviously, still, but. I find that changes how you make your decisions, right? What is the right decision, what is not? It depends a little bit.
Well, it's great because all this data exists. There's 25 years worth of stock exchange data for all the companies that have done different things. I'm lucky in the business school that I now sit because it's nicer in some ways to sit in the business school. Geology departments around the world are all struggling, to grow numbers and new positions. Business schools tend to get bums on seats in terms of students, so there tends to be more opportunity for growing the size of the faculty. But it also means that I get access to the top class sort of finance academics, as an example. Right? Mm-hmm. So one could do a study along the lines of you just described. In the finance world, they call it an event study. It's pretty sort of simple. It's like, what happened before you put an announcement out and what happened in the period afterwards, whether it's 1 day, 2 days, 5 days, whatever. And you can statistically analyze that. Yeah. And when you work with a high-quality finance academic, you can do it to a really high academic standard. So it's not just somebody crunching a few numbers on Excel and putting it up on LinkedIn or something. It's done to a financial journal standard. Yeah. And there's been some work done on that, and not enough. Again, it's that classic one of, we could organise a study now and sort of say, hey, let's look at the effect of maiden resource announcements on value, where they expected under a market efficiency hypothesis. Yep. That is basically that the market has already sort of corrected for what it thinks the resource is before the resource actually comes. So did the resource hit expectation, or was it below or otherwise? And I think, to come to your point, sometimes when you put some numbers on something, you effectively, that the shareholders were there sort of buying the dream, and suddenly the dream's actually got some numbers on it, so it's finite, right? So,
well, and also they've probably just woken up to the fact that they still had those shares, and I'd rather put them in this other tech stock that is just hot at the moment, So it's probably, but I think, we talked about this before because I have done those spreadsheet calculations with my limited statistical background because obviously I run OPEX, which I shared with you when we started it, and you can actually look at all of those data points, and you can mix compliance in there obviously as well. To what degree that has an impact on share price, as we all know, people are scared shitless about putting a correction out, but actually it's just another data point. It's another newsflash in people's faces, so it doesn't tend to move the needle, and if anything, it's up, not down. And I agree. There are trends there. I mean, drill intercepts, right? I mean, people just everything is world class, whatever everybody hits. Well, you can actually look at the data and work out what's really world class, and then see if it actually moves the needle. And it's really quite sobering to see what does and what doesn't move the needle. Emerson, actually, I think one of your companies is on that list a fair bit. They hit some good grade. You look at the share price and go, that's not what I expected it would do. It's but you got students obviously that you can work with to do all this wonderful data crunching. So have you got those things on the cook? Are you working on a few things at the moment, or?
A little bit. I mean, the MBA students can do something. It'll be quite often where, say, the best opportunity they have is we run, like many MBA programs, we run sort of projects for the MBAs. So, for example, previously, I won't mention a particular thing, but a resources-focused broker will sort of say, hey, could you do some analysis along the lines of what you've described, where the MBAs will do something along that lines for the broker. But obviously, in my role, I always give the MBAs the choice. They choose the projects, not me. So, there are always every year, roughly, because we're in Perth, we're a relatively resources-biased cohort, but it's roughly 50-50. So 50% of the class will get annoyed with me if I don't put up sort of resources projects, and the other 50% of the class will get annoyed if there are too many resources projects. So I roughly give it about half and half. But there are always projects every year that I really wish they would choose, but they don't. And so this particular year, there was a project. One of the brokers really would like some MBAs to have taken apart this whole sort of new sort of ionic clay rare earth type emergence of lots of 500 ppm, 1000 ppm, maybe if you're lucky, 1500 ppm type discoveries, and really collate all that stuff together, pass it through a brain, look at the different sort of test work that's been done by the companies, and really produce almost something that would form the foundation of a really nice piece of sector analysis for the broker. I would have loved it if they chose that, and the MBAs didn't want to do it. They would much rather work on something for maybe, again, I shouldn't mention it. We all know the sort of large resources companies or large banks or otherwise, and quite often it's in the MBA's interest to have on their CV that they've done a project for a name company.
Yeah, sure. Well, but then again, I mean, I get a lot of well, not pushback, but a lot of requests, I guess, for the critical mineral space. I mean, I would say the noises. I mean, I did a presentation in Amsterdam last year, and you can just sense that a lot of people. Well, it's not really a mining jurisdiction, obviously, but Europe at the moment in general is quite aggressively getting into this critical mineral space. So from a policy perspective, more than anything, but it's so rare earths would be something that people would get quite excited about, I would say. But yeah, I can see that you need to let people choose. So that's what you.
I see. On your point, actually, René, I was. My first geology degree was from the Royal School of Mines, Imperial College in London, and I just saw on LinkedIn the other day that they had a couple of new positions, lecturer, senior lecturer, and one of which was flagged particularly for critical minerals and the like. I just thought, hey, well done, that's great. A couple of new positions in the geology department, earth science department in Imperial London, but it's tough. I can't remember the last time that there was a new geology position in Perth at any of the universities. I've just been doing some consulting work for the WA government on some of the state of sort of earth science within universities and within the state. And the quality of people's fantastic, but we're not growing the pie. It's just like we've got half a dozen fantastic people in the Centre for Exploration Targeting at UWA. Similarly, in what they call Tiger over at Curtin, another half a dozen people who are fantastic. But the discourse and narrative with the universities is those people just trying to hang on to the existing roles and get their existing people on soft money to continue. There's no opportunity to grow the pie, and I can't work out why that is. It's really
well. Look, I mean, if you in your busy life, you probably don't have too much time to listen to my ramblings on this channel, but I talk to a few people in this space, and obviously the AusMM is very active in this future resources or future workforce space, the problem is indeed where are the geologists going to come from, and I mean even the folks who work in RSC here, there's some people who want to know whether they can do some of the lithium work and the rare earth work and not all this gold work, because what is that good for, right? I mean it is going to be a completely different world, and not necessarily a topic I wanted to dive too deeply on, because I covered it a bit here, and the solutions. I mean, I without being repetitive for the listeners, I call it my pendulum argument. There is nothing really you can do about this overall movement of young people wanting what they want right now in time. There's only so many primary schools you could go into and talk about what's in your mobile phones and all that sort of stuff. It's stuff that needs to happen. I find it interesting. So your comment about the School of Mines in London, and just my recent trip to Amsterdam and Europe, a lot of discussion and a lot of transition. A lot of my friends who work in oil and gas are now energy transition titles of some sort, right? And it is all. And that brings along the opportunity here as well. So rare earths and lithium and other things will become hotter and hotter. But look, I mean, to me, it's just we're just going along with the sway and doing what the industry does. I mean, there's only so much you can really do about it.
It's sort of. I don't have the magic wand. You're right. I mean, I've got 3 kids, and unfortunately, none of them have gone into the resources sector. One's a software engineer, so maybe my eldest may still transition. He's a quant and maybe do it, but not the others. I can understand why universities make the decisions they do, and I'm not trying to beat up on universities. As a vice chancellor, they will back the departments that are growing their numbers, and it seems odd for them to put new faculty positions into a department that's not growing its numbers, right? I can understand that from a vice-chancellor perspective. Mm-hmm. I think, though, from a societal perspective, and this brings in the sort of, we all hear about economic multipliers, don't we? Every dollar that's spent on X is supposed to create so many more dollars in impact. And to beat up on the old lawyers, I enjoy working with lawyers, the old joke, some of my best friends, but I do a lot of expert witness work. But let's say the law school in a particular university is growing really fast, whereas the geology department's not. Mm-hmm. The new positions will be in law, not in geology. And that's a rational decision for a vice-chancellor to make. But for society as a whole, I would argue that the economic multiplier on a geophysicist or a geochemist that's going to discover a significant ore body is probably higher economic multiplier than a lawyer that's going to help two companies fight over dividing the spoils or something, right?
Well, I suppose to not use double negative these days anymore, but let's just say stick to it. I don't disagree with that, but I think the universities are kind of losing their ground a little bit, right? I mean, and I haven't talked about this a little bit before, but there's not the classic institution where you just in the next 20 years where you're going to get your degree and then you get a job because you have this degree. I mean, all of that is literally changing around us right now. So, I mean, I can probably learn 95% what I learn at university from bloody YouTube at the moment, right? Absolutely. I mean, there are people out there that are. I mean, I spoke to Nick Tate the other day. The geologist out in the field with his camera, and he just records whatever outcrop. And well, what a fantastic! Well, there's nothing else but being in the field with this person at university and learning it. But I can certainly see how you learn a lot of things that way. So. Yeah, I don't know. I think universities are fighting a bit of a lost battle there on a big scale, people talking about micro credentialing and different places to get your education from. A lot of it will be online learning, specifically coming out of this COVID space. I mean, I'm just pumping out a whole bunch of sort of random data points, but it always a trigger point for me. And I understand, obviously, with your position at the university, it might be. Sort of, not difficult to talk about it, but you'd have to look at it from both sides. But I don't know. With a geology degree, I cannot see that coming right in the next 10 years by fixing something. We're trying to fix a problem that is just not fixable, and I think it's just because society is changing around us, and people will get their degrees from somewhere else and in a different way.
Yeah, I think I speak to. Well, I probably shouldn't say that, but I speak to a chap that runs a geophysical consultancy, and he can't get junior geophysicists, but what he'll say is, look, I'm just taking people with the effectively either software programmers or master professional engineering people. Essentially, it's quantitative people that can program, and then I'll teach them the bits of physics and geoscience that they need to know. And he says that's not easy, but the only people I can get are people that can actually code and do the quant. And then I have to teach them the rest. And that's sort of fine if somebody doesn't want to do a geophysics or can't now do a geophysics degree because the department may not exist, but can do a master's in professional engineering and then end up effectively doing a geophysical role in probably more geophysical processing rather than sort of geophysical interpretation from a geological perspective. It's bigger than probably you and me, René.
It is.
With my sort of university hat on, and with the business hat on, that there is that threat of substitution of the whole of universities. Should Google University, will that wipe out traditional universities or otherwise? That this sort of thing, will government-backed science departments, CSIRO, are fantastic at mineral exploration. Is the strength of CSIRO actually, creating the weakness or relative weakness in university geology departments, as an example? Right?
Yeah.
Does it really matter? If you're an exploration company director or of a mid-tier miner of some sort, does it really matter whether you get your sort of research help from CSIRO or from some university or otherwise? You just want really good research help, right?
That's it. Yeah.
So it's almost. I say I don't have solutions, but we are aware in university land that we are not.
Everybody.
A future that we justify ourselves. Yeah.
Yeah. No, and it's a wicked problem, I guess, that I ultimately doesn't have a solution, but we're so solution driven, both as an industry and as a human race, that's what we do, right? It's so you come full circle and you think, what are we trying to fix here? Better try to put our efforts somewhere else. And then recently, obviously, the whole Chat GPT movement as well. You can now ask an artificial intelligence bot online to give you an MBA course, and in 3 seconds, apparently, there is a very decent, from all accounts. I mean, I haven't done it myself, but from the things that you can Google and YouTube, you can get this thing to write you an essay, and it will score you 7 out of 10 points in 3 seconds. So all that stuff is bloody scary and at the same time interesting as well. But let's not go down too deep down that rabbit hole. It's an endless one. It's a fun one, but perhaps for everybody.
I would recommend it, René. I say we write a column every week for Mining News, and we purposely wrote one through the AI bot the other week.
Oh wow.
And revealed, we said, look, if we're joined by a leadership expert this week, here's the interview with the leadership expert. And then we revealed at the end that actually it's the AI. Right. So
that's I'll look that up. I'll put a link in there, because and what responses did you get to that?
It was called Leadership in 90 Seconds, I think, because it took us about 90 seconds to write an article that would usually take me, best part of a day or something. So
yeah.
Very pleased that it gave me the gift of time. No, I did get some good response in the fact that one or two of the readers sort of said, "Oh, great! Now I've actually gone on and I've bothered to log on to this." It was Chat GPT, I think it is, that's gone viral at the moment, and I've been asking it questions, and it's been really, really useful. But my own experience of it without the rabbit hole was, for certain questions it was really useful, and for other questions it would give you the wrong answer. So if you're actually vain enough to ask a question about yourself, you get totally the wrong answers about yourself. Yeah. So it's human. It's not human, but it has human frailties. Put it that way. It gets things.
Yeah, sure. Well, look, that's I'll go and read that then. But a few rabbit holes there to avoid. But maybe what are you working on at the moment? I mean, you're working on some big problems generally, and some big picture, topics. What's on your mind at the moment from an industry perspective? I mean, besides the obvious issues with critical minerals in the geopolitical side and the education space, what sort of problems are you trying to work on?
Well, I am writing a rare earth paper at the moment, as it turns, just a sort of partly market, partly geological. But no, the interesting one that you might find interesting, René, is with a finance academic. We're actually just putting a paper together on sort of the old Bitcoin versus gold thing, which has been done a fair bit, obviously, in popular press and the like. But we think there's a bit of a gap in some of the academic space, so we'll put something out around the various Bitcoin and gold characteristics. But one that we put out that was quite controversial maybe about a year ago with the same academic, that's Professor Sterk, who's in the finance world always comes out as rated number one in Australia based on his citations. So I'm lucky to be working with the sort of top person. We put a paper together about a year ago called Green Gold. Like, there's green every element of the periodic table, of course, at the moment, but we put a paper out called Green Gold that people can find. And that was really focused on this sort of tokenization opportunities for in-ground gold, which probably gets talked about over a beer at different conferences and the like. So everything's tokenization. Can you securitize, fractions of ounces of gold, a little bit like a sort of an in-ground gold ETF, so to speak? So we were just the academics. We weren't trying to create a product and push a product, but we did the sort of mathematical calculations from the financial markets on that. And pretty obviously, we probably already know the answer, right? That you can get exposure to the gold price through companies on the market, including exploration companies for gold, that don't mine any gold. So you can certainly create gold price exposure within any financial portfolio without actually having to own either a gold miner or even any physical gold. And that's sort of quite interesting in the sort of clean and green future-facing world that we live in, to sort of say, well, hey, if you can have all the gold price exposure, if you like, without having to mine any gold, why would you need to actually mine any gold, right? So,
well, hold on, aren't you just one step away from Bitcoin at that point then, or the principle of?
Well, it's sort of interesting. There's a few places you might choose to do it. So let's take the Pebble copper gold porphyry deposit, which I don't know. Some of my colleagues have been lucky enough to visit, but as I understand it, very close to salmon rivers and what have you. So
only small deposit, I think. Yeah.
So the chances of it coming out of the ground, it's, people will pay you to keep it in the ground, but we know the gold's there, we know the copper's there. Is that the sort of thing that you would actually securitize the in-ground ounces and the like, and actually be able to use that as an in-ground gold vault without stretching the analogy too far, as an example? Or another business model. Clearly, you can't redeem that gold if, for some reason, the owners of the units of the pebble gold sort of suddenly woke up one morning and say, "Hey, I need the gold, please." Then you couldn't mine it.
Not a bank. Yeah.
But you could have a business model where you could securitize some satellite gold resource that happens to be just 10 kilometers down the road from a mill, for example. So if you really desperately needed to redeem it, you could redeem it. So we looked at a few of those sorts of things, but I suppose from a financial perspective, what was very clear but was probably expected is that you can give yourself as much gold price exposure as you like with lots of gold companies that are explorers that don't actually mine any gold. So that was sort of interesting. So we'll do some follow-up work on that. There's a new CRC, Cooperative Research Centre. It's called a Digital Finance Cooperative Research Centre. And in the commodities space, they're really interested in this. What are the values and ways to tokenize certain commodities with a view to what you physically need versus what, if it's just an investment demand, is there a way to have an investment demand proxy for that commodity without having to dig it up and store it somewhere, that sort of thing.
Yeah,
so
that's really interesting. I haven't come across that at all. I mean, something did spring to mind. I mean, and I'm not sure to what degree this is confidential for the person who's trying to do this. So I'm just thinking out loud here without. I can always edit it, I guess. But there is also something to say with the push to protect. Oh, that sounds a bit weird. Push to protect the planet, like that's something we suddenly came up with, but. To buy these projects of resources that arguably should not come out of the ground, not for the sake of actually having an ounce that you can put your finger on somehow, but just for the philanthropic component of owning something that you then, just a simple, like own your patch of jungle in the Brazilian rainforest, right? And I don't know if that would have any overlap, but I could see a lot of companies and institutions actually, you could tie that into super, or people who do take, who have an interest in doing that, and then you would extract from the resource, the global resource portfolio, quite a significant amount of deposits. It's
interesting. I suppose because the sort of business model doesn't fully exist, and they sort of partly exist, there are certain people that are looking at possible products there. I'm not attached to any of those particularly, but so let's say we've got this 1 million ounces in the ground somewhere, and it's a little bit remote, so it's and a little bit low grade, so it's not quite going to make it in its current geometry and form. But
yes.
But we've got this 1 million ounces. The value of that will go up and down with the gold price, and still. And interestingly, at different points in time, there've been PhDs done on this. Actually, I should give a plug to John Bell, who did a great PhD on this 10 years ago, looking at the in-ground values of gold in West Africa versus Australia at different points in the cycle. And exactly the same gold with the same grade, same resource classification, roughly similar geometries and potential future costs of production would go up and down based on, gold price, but also on a sort of risk on, risk off dynamic around whether people actually are risk on, so the West African ounces are worth more, or risk off, so suddenly the Australian ounces are worth more. So there's that whole dynamic. But clearly, if you've got this 1 million ounces, let's say it's up in the Arunta somewhere, it's a little bit remote. Arunta's a region of Western Australia. That value of those, could you sell those units in the ground? If there's an explorer, those units go up and down, the shares in the exploration company go up and down with gold price. But if that person changed business model and sort of said, we're only ever going to leave it there, does that suddenly mean that the value wouldn't go up and down with the gold price, because even though the gold's physically there, that they've declared that they will never actually mine it?
Yeah.
There aren't enough of those sort of real examples yet. We can only prove that the value goes up and down with the gold price, but does that require that there's a future potential that someone would actually dig it up for that relationship to hold? Or does somebody declare it moratorium, 1 million ounces in the ground, but then sells the units of those off? Would they actually trade with the gold price or not? So
yeah, that is really interesting. Yeah. So is that still work in progress? Is that way? Because you said that was last year, but you've still got.
There's still work to do in that. Interestingly, we're looking at it for other commodities as well at the moment, which to me makes less sense than gold. I mean, to me, gold is money. When I first came to Western Australia sort of 30 years ago or more now, went out to Western Mining. At the time, we owned all the gold deposits through St Ives Field and the like. And I was trying to get my head around, what are we actually doing here? We're sort of digging this stuff up at, a couple of grams a ton. And at the end of the day, I reconcile it to myself. So look, we're just mining money, So if we can dig it up for 300 and sell it for 500, that's a good business, right? But then with all the environmental externalities, maybe these days, if you could still get that return without actually mining it, then why wouldn't you? But so that's the sort of thing. So there is some more work ongoing, but we're being probably nudged a little bit towards other commodities, where for me it makes a little bit less sense than for gold, because gold is fungible money.
Yeah, no, okay, I agree.
Units of iron ore in the ground, I'm not necessarily sure that.
No, intuitively that doesn't make sense to me either. I mean, gold is money, as you say. That's the only place where that argument would. Maybe just a stupid geologist question. I mean, and this is the question, the Christmas party question that you would get. I mean, do we still mine gold in 50 years? Is this because I mean, I've never believed in Bitcoin, but I should eat my words, because I heard yesterday from a friend in Zimbabwe who had made his fortune on Bitcoin last year, and he said, I'm taking 10 years off. So that's the first and only person I know, but I thought, okay, good on you. But if you hear the Buffetts of this world talk about Bitcoin, then I stay a mile away. But gold as a function to underpin, the capitalist society that we live in, I don't see it changing anytime soon. Or is that just a real short-sighted view?
I'm not sure I have the answer. The current paper we're working on, where we're looking at all the different risk profiles around Bitcoin versus gold, and they're vastly sort of different in terms of what the sort of finance people would call systemic risk versus what they call idiosyncratic risk. And systemic risk is basically system-based, financial market-based risk, and Bitcoin has loads of that. Mm-hmm. Far more risky than the gold price. You'd know that from the volatility. And thankfully, your colleague got the right time, perhaps. Whereas gold has a lot more, at least the gold equities have a lot more idiosyncratic risk. And idiosyncratic means unique rather than idiot. But the idiosyncratic risk comes from management, right? So the fact that we're not very good at managing assets, we tend to make mistakes when we're managing and digging up gold mines. So I must admit, I do quite like the idio bit in the front. It's meant as unique rather than idiot, but
it does apply. Yeah,
engineer colleagues, but we tend to make a lot of mistakes. So part of that research that I'm doing, again, where it's nice to have credentialed sort of financial academics that can do it to the highest standard, are the unfortunate thing is most of our gold miners, let's put it this way, there always are exceptions, but the distribution of returns from gold mining companies would actually underperform the gold price. That's really quite damning, isn't it? Right?
It is. Yeah.
I don't have the exact distribution to hand, but let's say that 20% of gold miners actually outperform the gold price and 80% don't. So that the sort of median performance or average performance is below the gold price performance. So unless you're able to pick winners and find that 20%, you're better off either just investing in a gold ETF, as an example, or even better, invest in, not that I'm trying to push the barrow for anybody, but even better, invest in gold royalties companies, because gold royalties companies typically outperform gold miners, but they also outperform the gold price. And so you sort of say, okay, why do they do that? And I think the answer to why they do it is pretty sort of simple. It's that they've got no cost exposure, so they've got the revenue side exposure of the gold price, so that they track the gold price, but they also add ounces to the portfolio, right? So they get both the gold price exposure plus they get more gold, so that hence they outperform the gold price. So that's sort of almost like Believe it or not, that's not properly written up in the academic literature yet, but I think it's fairly well known within sort of investment banking circles. But those of us that are diehards that like to invest in gold explorers and gold miners, we always think we can pick the winner. But if you're a stand back, you'd say, I'll invest in gold royalty companies, then gold physical or ETFs, and then the actual miners with the idiosyncratic risk. Whereas Bitcoin has far more systemic risk than idiosyncratic risk, because Bitcoin miners just need a cheap source of energy and they turn it on and off they go. It's simple.
I find it fascinating. I mean, I'm not an investor, and it's just not my strength. I don't have any interest in it really. But it's always struck me that, and again, I picked it up somewhere, that the mining space in general is just not an attractive return on investment. And the fact that gold is or should be worth so much more, and that indeed the numbers that you just mentioned are rather damning. It doesn't make it very appealing. And there's got to be, on top of that, I mean, separate gold out, because that's obviously the odd one out if you look at what we need to dig out of the ground. I mean, it underpins an entire economy. It's money, as you say, so, for sure. But that argument might not float for another couple of decades. It's interesting that that the industry, from an investment perspective, also has such a bad rep, because this is where it's happening, and to enable us into the future and doing all these good things, we need this. And yet still, whether it's gold or critical minerals, it's still so hard to make a return on that. So I find it's a really troubled. It sounds very negative, doesn't it? I mean, why on earth would you invest in a mining company after listening to this? I'm
a little bit more glass half full, René. I'd agree with you. Certainly, I don't have fully in my head the sort of the actual return on capital or total return to shareholders over particular sort of windows of time. But I think it would all. I think the answer is that it depends on the industry. So iron ore miners have done very well, thank you very much, because the iron ore industry has this fantastic sort of oligopoly structure with only a small number of players, and returns have been really, really high, again, thanks to the China-driven demand side, of course. But there's a Warren Buffett, of course, we always like to sort of quote Warren Buffett in various things, but to cut a long story short of Warren Buffett is he believes in the industry rather than the firm. So he'll say, look, if you want to know who's going to make good money, have a look at the structure of the actual industry. And, monopolies from an investment perspective, rather than a societal perspective, monopolies are good, you'll make money. Oligopolies, where there's only a few suppliers of something, are good. A really competitive market, which is a price-taking market where there's lots of firms with small market shares, which unfortunately sounds like gold, by the way. That's usually not a good place to make lots of money, particularly if the barriers to entry to get into it are not particularly high. And it's tougher to build an iron ore mine for a few $1 billion than it is to build a gold mine for a couple $100 million. So again, that goes against gold. So the fun Buffett thing is he's very much an industry person. He says, pick the right industries.
Right.
Companies in good structured industries will do well, and badly structured industries, the equivalent of sort of corner shop operations, are always going to lose out to the sort of the
what's an example? What would be an example of a badly run or of a bad industry?
Well, actually, by Buffett's context, gold would be a really bad industry. Although a couple of years ago he actually made his first investment in gold, as I recall. Yeah. I think it was Barrick he went into for a while. I don't know if he still holds that position, but gold is what we call in a business school context is what is a perfectly competitive market. There's lots and lots of players. No country holds a monopoly over it. I think Australia is the second. China just pips Australia. Roughly 11% of global production. So no country has a hold over gold. All the biggest miners, Barrick and Newmont, are maybe 5% of the market, something of that order. So there's no equivalent to the 3 or 4 companies in iron ore that account for 80% plus of production. So if you had to choose between gold and iron ore, you would go, you'd choose iron ore as the one that will have returns to equity. So Buffett has another quote, which I'll get the quote exactly wrong, but he sort of says, so he believes in industries over firms, and he'll say, so I think the quote goes something like, if you take a management team with a good reputation and put it in either an industry or an asset that has a bad reputation, only one reputation survives. and basically he's sort of saying that the asset, if it's a bad asset, will beat even good management, and a bad industry will beat good management. So he's very much on the industry beats the firm. That's a little bit depressing too, really, because as managers, we always think we can make a difference. Right?
Yeah. I just said the exact opposite in the previous talk, I think, because, I always say something along the lines of, and I didn't know this was a quote by somebody else, but, I'd like to think that a good team of people can make a fairly average project work, but the other way around doesn't really work. If you've got an average team, you've got a fantastic deposit, you can still completely screw it over. So, but maybe that's...
I'm probably the other way, René, but this is one of these classic ones where we both have opinions and we haven't actually got the study. I think there's a sort of a saying that the majors and various things, they sort of say a really good asset's pretty forgiving, right? So I think I've got every regard for management of companies, and they're typically junior companies and mid-tier companies that are running third and fourth quartile assets on the cost curve, as opposed to the managers in the majors that are running typically first and second quartile low-cost assets. It's easier to run I would argue it's easier to run a lower cost asset than it is a marginal asset. So the people in the little juniors and mid-tiers are really earning their money by managing to make an average asset work. Hats off to them for doing that. One of my quips in many of the worst selling books, it didn't help sell any more books, but we talk about a fifth quartile asset, and in which of course doesn't exist. It's sort of, we'd love to be on the cost curve, but we're that bad that the asset's like, losing money. It's not even on the cost curve, it's in the fifth quartile. So unfortunately, over my time, I've been involved in a couple of those. So.
Yeah, I'm sure. Look, as they say, you got to be part of a few failings to learn things. So that's look, it's fascinating stuff, and like I said, it's not really my swimming lane, I guess. But so many forces working with each other or against each other, and I'm just grabbing the popcorn and trying to make sense of it all. But
hopefully, people might be interested if they're listening in their own careers. I would hope they are. I think you're making the same point, which is you learn the most in the toughest jobs, which are the third and fourth quartile and even fifth quartile, to use that the joke.
Yeah, I like that. Yeah,
that's where you really learn the most because you're struggling, and whereas where you get your reputation is actually by having the name companies on your CV, which are usually the first and second quartile assets. So I think you do need some combination of both. You need to have, in fact, I won't mention him by name, but there's a former MBA and mineral economics master's student who's doing great things and just become a CEO actually. And but when I met him about 8 or 10 years ago, he had like the toughest CV you've ever seen. So he'd been like the engineering manager on this plant that had literally blown up or caught fire. He'd been on another project build that had had a massive capital cost blowout, and all these things were on his CV, and it looked really bad. But what he would have learnt in those roles was amazing. Yeah. And I'm lucky enough to introduce him to somebody I would consider my mentor, who gave him some career advice and sort of said, "Hey, look, just take an easy one. Just take an operation that's running really successfully." And luckily, he got into a new build which came in, a world-class asset that you couldn't really get wrong. But then they were also building the project at a low point in the cycle, so they came in on time, on budget.
Yeah,
whatever.
Nice.
And he's now got that on his CV. But he said, actually, that was really easy to do.
Yeah.
What we learned the most from was the really tough things on the CV that everyone would sort of say, "Oh, wow," But it's got him a CEO role, so.
Well, that kind of works, that philosophy then.
Of two things, isn't it? I sometimes joke and sort of say, in a 30-year career, I spent 2 years at McKinsey and I spent 5 years in Oxford or something. Well, that's 7 years out of 30 years.
Yeah.
Plus, but when you get introduced to somebody, it's always like, "Oh, here's Allan, he used to work at McKinsey," or "Here's Allan, he's from Oxford," or something.
Yeah, right.
You learn more putting a company into administration when you've sort of slaved away on it for 18 months trying to keep it alive, then that's where you really learn rather than.
Well, look, I completely agree with that. I mean, if I just mapped it onto my probably less, or somewhat paler career, it is the struggles in difficult locations in around the world, and it doesn't have to necessarily be Africa. It could be in Australia or west coast of New Zealand. It's the challenges. I mean, probably cliche as well, but obviously you need to seek that boundary. Otherwise you don't learn. And I look for that as well. You don't want to have just everything handed to you because you don't know what difficult is. So that's and that's what I like about the industry, because it's daily challenges and it's fascinating how it all hangs together. So there's never a dull moment in this industry, and that's so much fun. It's
one of yet another study that I'll never have time to do, or maybe if there's somebody listening that really is interested in sort of academic studies on resources companies, but looking at board compositions is actually quite interesting. We talked a little bit about that earlier on. But the hypothesis that I've got, which I would like to do some analysis on if I ever get time, would be to look at larger company boards and smaller company boards. And clearly there are patterns there that we've discussed. But I do think there's a little bit of a sort of a divide, that people that are on small company boards tend to end up on more small company boards, and people on large company boards will get more roles on large company boards. And there's not that much cross-fertilization between the two. In my observation, I don't have
sure
to back it up, and I think the reason for that is that the larger company boards don't want the person that's been involved in two companies that have gone into administration or worked on some project that ran 5 times capital cost overrun. It's almost the risk profile of the
risk profile is completely different. Yeah,
they don't want to have someone that sort of got things on their CV that that company didn't do very well or whatever it might have been. Whereas in actual fact, that's exactly to some extent what they need. Right? That they
I was going to talk. I thought maybe you wanted to not steer back into that, but I actually really enjoy that space. I mean, the thinking about board composition and the skills matrices that you need to have to understand what each director is actually contributing, because I can completely align with that. I mean, if you're sitting in a big company, your risk tolerances will be lower. And if you're sitting at a small company, depending on, you're competing with 600 other juniors, something's got to be different, And I was talking to a young MD just the other day, and I said, "What's the point of difference? We're excellent in what we do." Well, I'm sure that's true, but how do you point that out? And you have to take a risk of some sort. So those directors, by definition, will have a bigger risk profile. But on the other side, if you work for a large company and you got 9 directors sitting around the board, and they're all the most boring, risk-averse people that you'll find, you won't do that magic deal with some up-and-coming, star junior that, like a Sol Gold. You miss out on a Sol Gold deal or whatever. That's probably not the right analogy, because you just don't have the right people on the board. So, I think. I haven't done, your governance work is obviously, exponential compared to mine. But what I do really find fascinating is looking around the boardroom and indeed trying to not say how good people are. I don't think that's the right label. I mean, people will be good in their technical disciplines, but it's about the understanding of the risk tolerances and then applying it to that business. I mean, same in my business. I mean, I'm a privately held consulting group. I'm a risk taker because I'm an entrepreneur and I'm here to grow stuff and do more fun stuff and, build in countries and so on. But I've got 2 other directors on the board who are particularly not risk taking for a reason, because otherwise we'd be off the hinges. So I see what you say, but how would you do a study on that? You wouldn't really numerically quantify that. I don't know how you would do that.
Well, I mean, I think that actually, remember, it was one of the first management books that I read was back in the sort of mid-90s when I sort of got the bug for sort of management, and it's still a book that one can get, but it's called The Fish Rots from the Head, right? Which is effectively, it was not so much a management book, it was a book on boardrooms, really. and the fish rots from the head is obviously a saying. I think it's an Eastern Asian saying. I'm sure we could Google it and get the history from it, but it basically sort of says it's the boardroom's important, right? And potentially can get it wrong. That was a UK-centric book, and it mapped out all of the networks in the UK boardrooms. So it's very much a case of here are the top 50, 100 companies in the UK, and effectively it's a little bit of a club, and people swap around a little bit type thing. And those sort of inverted commas clubs exist at the bottom end of the market as well. So there are any number of people everybody knows each other in Perth, in West Perth in particular, and they may end up on multiple sort of companies and roles. But I think there is that. So you could effectively map the networks and sort of basically look at whether there is enough. Look at the level of flow by size of company versus by commodity, by any number of ways. You look at the level of flow and sort of say, okay, to what extent is the level of flow statistically significantly different between certain companies and other companies? So I think that one could design a sort of a research piece there. I suppose with all those things, as an academic, you find those things interesting. Putting my old consulting hat on, I should say, so what? So it's like,
well, no, because the commercialization is there. Because I talked to some entrepreneurs about this who had, and this was going back to the start of OPEX, where people started ringing me up and said, look, maybe there's an overlap there because, I have, terabytes of public reports that have directors in them and that cross-pollinate between these companies. And they're either successful or they're not. So you can measure that by share price. So we did play with these things, but, at the Excel level, I should add. But, you could definitely, the data is there. And now with all this fancy AI stuff, I'm sure you could find that signal and do something with that. And you say for what? Not for the academic good, but from an investment perspective. And that's, and without giving the idea away that somebody came to me with, 3 or 4 years ago. So if I'm giving this away to whoever is listening, I'm sorry. But, the idea, obviously, if an investor can pay for his subscription at the time the idea was OPEX, to then also get the risk rating for a director or the cross-pollination factor or whatever, the up and down, whatever you want to call it, there is a way there to link that back in with success, whether it's exploration success, takeover success, or there is... No, maybe we should have another coffee on this next time in WA.
There's an article in that for whatever it is. I think I'm not that close to it, but there's a video game, isn't it? FIFA football, FIFA soccer, or something where you choose your players. It's not quite it's almost fantasy football where you pick somebody and it's their heading ability and their shooting ability.
Yeah, exactly. Yeah,
ability, and so it's a little bit like that for directors maybe.
Well, you can the gamification is a big word, right? In terms of all of these new ways to present data, that makes it entertaining and visually appealing and very accessible for people to just look at a scorecard is probably not the right word, but like you said, like that FIFA, not that I play it, but you're right, yeah.
I think it reminds me though, and it shows how little distance I've come perhaps in sort of 50 years plus or something. I remember as a little kid, you'd have these sort of things like a donkey derby, we would call it. Your family would take you out to a donkey derby, and it's like a horse race really, but there's just little donkeys, and they'd get some people from the crowd to sit on them, and then 6 donkeys would go around, and then one would win or something, right? And then you could put a couple of dollars on these things, and I think all the proceeds went to charity or something like that. And so I remember watching this. Oh, this is really exciting, and the donkeys go around, and number 3 wins, right? And so out of 6 donkeys, you then just look at the queue for people to put money on to the next race, and the queue in front of number 3 is very, very long.
Yeah.
Even though, interestingly, what they used to do was they'd change all the numbers on the donkeys, so it made no sense to queue at number 3 for the next race, but they're very long. So clearly, I think that separating luck from skill is very difficult. So of course, what they say, I think probably always Napoleon, is it? Find me a lucky general rather than a skilled one. I think you hear that in geology very often. Don't you? I don't want the best geologist, I want the luckiest one. There are some academic books on actually trying to separate luck from skill statistically. I think the one that it's fairly reasonably heavy reading mathematically, but I think it's called something like the success equation, and it'd be from an American publisher, fairly scholarly book, and it actually tries to separate out and statistically do the work on different sports. And unfortunately, with it being an American book, it had more American sports than sort of, so baseball was there.
Yeah.
Baseball was quite heavy luck.
Yeah.
Luckily, chess was in there. Chess was almost 99% skill, 1% luck type thing. As baseball might be, I forget the exact percentages. American football will be in there, basketball, and so forth. And so when we do our analysis of directors, there's a halo effect, clearly. So if you're lucky enough to go and, I recall when I worked for WMC, Cambaldo, we had a new graduate come in, his first diamond hole that he drilled, he hit a new nickel chute. We thought, wow, fantastic, that's great. And that really, really helped his career post WMC. You could sort of say, hey, I discovered
of course
this
deposit,
right? And if one assumes that the first hole that he would target wouldn't be the most skillful job he'd sort of ever done, that there was a little bit of an element of luck in that you're in the right environment. So statistically separating luck from skill, one can do, but clearly the market for luck and skill is not efficient. And that's the Donkey Derby example. So that even if that person, and perhaps it'd be an unfair choosing of it, even if a person that happened to be a lucky geologist was not a particularly skillful geologist, the market will still support the lucky geologist in the next role.
Yeah. And,
there's a positive payoff to that geologist from luck. Yeah. This comes into the sort of Nassim Taleb type, fooled by randomness, black swan type business literature. So it's a fascinating space. It's where
geez, you've given me a whole angle of look, I think I now need to take 3 weeks off to read all these bloody books that you've put out there, because I do.
Financial statistics meets behavioral economics.
Yeah. Well, look, I mean, but that's obviously where it's at, a lot of these things. And then coming back to what we were sort of just musing about, the ability for us to see a signal in that. Yeah, good luck with that one, right? Because, you run a junior and, you're at the right time, later 2016, 17, and right at that time you're floating a gold project. Well, that's not because you were waiting for 5 years for that exact time that you didn't know about anyway. That's just the luck of the trend at the time, right? So, geez.
We have a exercise I give to the MBA students. Actually, I don't want to give too much away on it, René, otherwise they'll know the answer, right? But I sort of can. So I give them a project. We call it Standard Mineral Resources, and actually it's a little exploration company, and it's got hardly any cash left, and it's got these exploration commitments it's got to make, and it's got this sort of board made up, and it's got these little assets, and and I give this to a set of MBAs, some of whom will know something about resources and some of whom won't. But we'll sort of say, hey, look, there's 2,300 or thereabouts ASX listed companies, of which 800 or so are junior resources ones. So the chances are your first role, particularly in Perth, if you're going in the boardroom, might be in one of these companies. So good luck. There are all these little exploration assets. What are you going to do? How are you going to sort this company out that's clearly running out of cash, and it's got all these commitments that are building? And come back an hour or so later, and they've got all these ideas about how they're going to slash the managing director's, salary in half, and pay a few people in shares, and maybe pay a few drilling contractors in shares, and get rid of one of the non-exec directors, and all this sort of cost-cutting stuff. And we're going to joint venture these deposits or these assets or otherwise. And the interesting thing is there's only two possible answers, and everyone gives one of the answers. And at the binary level, the answer is either you solve the problem with what the company's got now, or you solve the problem with something else outside of what the company's got now. And the error type that everyone makes is they try and solve it with what they can see in front of them. Mm-hmm. To which I say, well, actually, in practice, what tends to happen, I call it the shiny new toy strategy. Mm-hmm. In practice, what happens is someone will just say, hey,
lithium rock chips.
Yeah, which today would be lithium, of course.
Yeah.
But also the shiny new toy could be a new person in the boardroom, to come to your point, René. So, you bring somebody in that's got that sort of halo effect of, wow, they've just appointed Josephine Bloggs on their board, and Josephine Bloggs has got this fantastic track record.
Yeah.
And of itself, that appointment can make a difference.
Now things will change. Now you see that all the time. You're spot on. I mean, that's it's a great strategy. And How do you, coming back or weaving that in with the previous point, I mean, that'd be very difficult to quantitatively assess any of those effects, I guess, those halo effects, the luck effects would be, I can see it's a minefield. But interesting though, because with the sheer amount of data that there should be, and these new, I mean, it's not new because all this shit has been around for 60 years, obviously, but all these newly applied algorithms, I guess, is one way to put it. There might be something there. Yeah. Now, look, you've got some fascinating stuff to play with. That's
many careers. I think my take. I'm not smart enough to be able to crack it, René, but luckily I work with some finance professors that can. Yeah. So the trick I find is a little bit like earlier in the conversation we were saying that how do we sort of get into writing 10 worst selling books, or how do you understand the boardroom, in that the technical people don't understand the financial commercial people and vice versa, and that you've got to get that Venn diagram overlap.
Yeah.
I would, without being overly disparaging to my finance colleagues that I've been sort of talking up, that the finance colleagues will write great papers, but they'll design the data sets in a way that they answer questions that aren't worth asking.
Yeah.
Say, hey, look, I've analysed this index of gold companies against something or other, and I get these sort of results or otherwise. And if you actually sort of say, well, let's have a quick look at this index of gold companies, and you sort of say, well, okay, that's not a gold company, it's an iron ore company, and that's not a gold company, it's and so that maybe we should blame the stock markets for that, because the indices that are designed are not actually what they're supposed to be, right? And that probably comes back to management changing tack at some point. At one point they were a gold company, they got into some weird little small gold miners index that someone's using, and then of course they then decide to do lithium or whatever it is, and so that contaminates the index, but it's not updated.
Yeah.
So I would say the finance academics do great work on data sets that are so contaminated that it actually ruins what they're trying to do in the first place. So there's a role for someone from the industry that can actually say, no, look, let's pass this through a brain first and actually work out what these companies actually do to create the right buckets to actually analyse, and then we'll get a better answer. So I think, that's what I'd love to do, but I think out of 120 academics here in the business school in Perth, believe it or not, there's probably, let's call it 10%, there might be 12 that are interested in resources, economics, business or otherwise, which to me is a bit underweight, but
maybe we should wait to the next downturn, and you get some people back from the industry that might be looking to do something like that. I mean, it sounds super interesting to me. I'd be up for that. What talking about downturn, maybe just a quick or like a topic to close off on. What does your crystal ball say for 2023?
Oh gosh, actually, I was asked this recently by a publication in WA here, and their specific question was, what's the chances of Australia being in recession in 2023? And I think I went 10 to 15% for what it was worth.
But I'm being very industry specific here. I mean, the Australian recession and the housing market and the whole thing going to shits is probably inevitable to some degree, and that obviously has a knock-on effect. But if we and prices also aren't the same, or commodity prices aren't the same as the health of the junior exploration industry, if that's what's a lot of the listeners here are worried about. I mean, the gold producers will be the gold producers, and the barracks of this world will make money at 1900 and at 1600 and at 1500, so that they'll be fine and beyond. But from an industry health, very broadly, right, and maybe just without steering you into an answer, but one of the things that I've been or from a large trend, I mean, is the Criticals Mineral Initiative strong enough to support pretty much everything else that's happening? If you assume that gold is probably remaining sort of stable enough through all of this chaos, I can't unsee that. Some people can, I guess, but maybe I'm a bull. Is that enough to prop everything up in the super cycle kind of argument, if you like?
It balances almost perfectly, actually, René. So I happened for some consulting work that I was doing with CRU recently to just produce this exact chart, which was, and obviously you've got to assume prices, let's say to 2030. So from 2021 to 2030, I happened to use, I didn't have final calendar 22 prices at the time, but roughly there's about $150 billion negative, as it were, depending, in the fact that there's no growth in the iron ore space and the price might come off a little bit with the sort of, peak steel type thinking and the scrap cycle in iron ore. So it all depends on what iron ore price you use. But let's say you're negative 100 billion, then you get that 100 billion back from the combinations of the critical minerals.
Right.
So roughly the equation balances to 2030. But again, it's all your price assumption dependent. But
well, look, there's obviously a lot of assumptions, but the sentiment or what it feels like is that there's and every news article is picking up and then obviously inflating it even larger. That the stuff that we need is so much disproportionately larger to what we have coming out of the ground right now. That we need, the word revolution and so on. And it almost feels like that equation is lopsided. Iron ore and a number of other things might dip, but the amount of this other stuff that we need. So it's interesting to hear that take. I mean, that's and you said so. There's nothing published. This is private work that you've done.
It was a government piece of consulting, so I think there will eventually be a public report on it. It's not out yet, but so that equation roughly balanced. I think there was another one that I saw though. That's not as, it's sort of interesting. There are sort of people that are either, a bit like most things, the opinions on critical minerals are quite often stronger than the data.
Than the fundamentals, sure.
So the interesting one, I mean, there'll be people with strong opinions that say, look, lithium's a bubble, never going to go anywhere, it'll be all over next year, there'll be new battery technologies, all the rest of it, etc. So that's one extreme viewpoint. There's another extreme viewpoint that sort of, lithium prices are high forever and it's all going to be fantastic, right? And of course, the reality is somewhere in between. But if you look at the lithium market versus, say, the copper market at the moment, if you extrapolate based on current prices what the size of those markets are going to be in 10 years' time and the like, you end up with some sort of crazy number that the lithium market's going to be as big as the copper market, which is not correct.
No.
That means that the price of lithium will come off, and that's fine. I still think that lithium is a fantastic business with prices that are half what they are now, clearly.
Yeah, right.
And the great thing about lithium is that there's lots of it. That's the other misnomer that perhaps sometimes people sort of get wrong, is they say, well, lithium's obviously going to be terrible because it's all over the place. Anybody can find it, and the search space is very immature. So yes, you can find it. But that's actually a really good thing. That gives lithium the opportunity to become the next aluminium, so to speak, right? Yeah. As opposed to being, as opposed to the next scandium, where there's just fit the market into what used to be. Trevor Sykes, who used to write those brilliant things for the Financial Review, used to say you could fit the market for certain niche minerals into a phone box, right?
Yeah.
Now the problem is we don't use phone boxes anymore, so maybe that's lost its currency to some degree, but the nice thing about lithium is it will be a big market because there's lots of lithium around. And
and just the fact that Forrest and Reinhardt have just poured I don't know how many millions in this rare earth space, and this was it yesterday? What was the other deal that forgot the bloody name now? It wasn't a project that I was aware was, but another $125 million investment in rare earths. Maybe, did you pick up on that? Or?
I didn't know. I'm still digesting a $20 million lithium deal that was announced the other day, where they haven't even drilled it yet. But
well, there are some companies that are still, I don't know, $500 million market caps, and they don't have a resource, and I just wonder how that's even possible. But
I'm a big lithium fan, but I would qualify that by saying, personally, I'm not buying into the very large market cap.
I hear that. Yeah.
That's where. So it's not a sort of buy all things lithium. I do think values have got a bit stretched, and but I do think lithium has a big future. But clearly, with current prices and current growth rates, it's not going to get bigger than copper in 10 years. Right? Something will readjust, and it'll probably be that lithium prices will come off a bit, copper prices will go up a little bit in relative terms. That sort of thing.
Up and down, and we up and down the roller coaster. Sorry, yeah.
to come back to your question, I don't think everything's going to fall in a heap in 2023.
Yeah.
If iron ore price is $100 or whether it's $75, the big producers will still make really, really good money. Gold producers, I'm slightly worried. There's a brilliant guy, and you'd know him well, Sam Ulrich, that puts together the quarterly gold cost curves for Australia, and that scares me in the fact that there's been 10% cost escalation per quarter.
Yes,
margins are getting squeezed in the gold sector a little bit. So I think, again, much as I'm a fan of gold mining, I'd probably, I've got a couple of gold coins in my office at home. I have to be a bit careful. There's one gold coin. They don't break into half.
Fake. They're fake,
yeah. But I'd rather have, ETFs or in gold or otherwise. I'd be a bit worried about the sort of squeezed margins in the gold this year, but hopefully we get on top of inflation.
Well, if the latest week is anything to go by, maybe it's a thing of the past. 1900 this morning. It's look, I don't watch this. I don't have the app open with a cup of coffee in the morning, or do I? Maybe, but you make a good point. I mean, that's not sustainable. So, but I should get Sam on. I think that's a good discussion. Actually, go into that a bit of detail.
He's done a phenomenal job both with the cost reporting and so his work in emissions. Analysis in the gold sector is first class. So he's just finishing off his PhD at the moment. He's done a brilliant job. No, I caught up with a cup of coffee, I think, in West Perth before he started that, and we talked a bit about data and about these kind of things. And data is fun. There's so much to see in it. And I'll drop on an invite. I haven't spoken to him for some time, but Allan, it's been fantastic talking with you. I could talk for hours here, but I think we might need to go back to work. Well, look, thank you, René, and I hope we haven't gone. Apologise for the rabbit holes that I perhaps went down on occasionally, but hopefully there was some useful stuff in there for anyone that's got the fortitude to listen to the whole thing.
I think so, and you'll be surprised. And I really enjoyed it. I think there's a lot of value there, and really great insights. So thanks again for making the time. And next time in Perth, if you're around, shout you a beer or two.
Yeah, and there's a university mug waiting for
you. Oh,
yeah,
and I need to take one of the mugs back home. Yeah, good on you, man. Thanks so much. See you again.
Cheers, Ray.
Bye.
Bye.